Let's certainly get started. So thanks everybody for joining us this morning for a conversation about donor advised funds and how to utilize those effectively for giving purposes to do good from a tax advantage perspective as well as a philanthropic perspective. I was just at a conference last week on planned giving. Donor advised funds are the fastest growing philanthropic tool in the entire nation. So people are definitely utilizing these tools. They're seeing more and more value for these kind of tools, and we're excited to be able to share some things today about how to leverage them and maximize them accordingly. So just some housekeeping kind of things. You're more than welcome to ask questions during the session. You can also type those into the comments section. And as we have time, either at the end or even during the presentation, we'll ask those questions and make sure that they all get answered during the session today. We will send out a copy of all the slides as a follow-up. So you're free to take notes and you're encouraged to take notes. At the same time, if there's something on a slide, you don't have to write it down word for word, but you're going to have it in your inbox following the presentation today. So those will be shared with you as the meeting ends. Today, Dustin Petz is going to be our presenter. Dustin serves as the president and CEO of the Kansas Methodist Foundation. Most of you are probably familiar with Dustin, but just a little bit of background. Dustin serves as an ordained elder in the Great Plains Annual Conference of the United Methodist Church. He took this role in 2018, so he's been at this for about 6 years, working for the Kansas Methodist Foundation and leading that organization. Prior to that, though, he was a pastor for 18 years, a local church pastor. Always had a tie to stewardship, always had a love for stewardship. So it was a natural transition to go from local church ministry into the foundation role. He received his education at Kansas State University. Don't hold that against him. K-State's a good institution. Yeah, Nancy's like, heck yeah, that's a good thing. So he earned his bachelor's in agribusiness there, and then attended St. Paul School of Theology for his MDiv. Has a master's from Princeton in theology, and certainly also has his doctoral degree in ministry from Wesley Theological Seminary. He's been very active with the Great Plains Conference and the General Conference, serving on numerous boards and committees that have to do with quite a bit of financial affairs there too. So Dustin's going to be sharing his screen today and sharing the presentation. So Dustin, I'm going to turn things over to you, and we look forward to hearing your words of advice.
Awesome. Thank you, Tyler. And welcome, everybody. It's great to have you join with us and to share in this presentation time. So I'm grateful for you. Let us offer a time of prayer as we begin. Gracious God, we give you thanks for this day that you have made. Help us to rejoice and be glad in it. We pray that you might find us faithful with how we use the time and the gifts and abilities and the resources that you've entrusted to us. Remind us that our lives do not consist in the abundance of our resources, but consist based on you. Help us to be good stewards. Help us to learn new things and to think about how, through your Spirit, you prompt us to make a difference in the world through those resources. Bless our time together today. In Jesus' name, amen. Tyler, maybe you shared this, but I'm not for sure if I'm remembering, but we're recording it. So if you're able to mute your device, just in case there's background noise, that'll be helpful. We'll create a video that we'll share out with others. So let me say a few words about the foundation. The Kansas Methodist Foundation's actually been around 60 years. We celebrate 60 years this September as a charitable organization, primarily for the purpose of caring for legacy gifts, as well as partnering with Methodist churches, agencies, organizations across Kansas to have the resources to do ministry that God is calling us to be about. We're a separately incorporated 501c3 charitable cause. We steward at the beginning of the year, we were stewarding just over $75 million and make distributions based on donor directives or based on the accounts that we serve. And it's an important ministry of both stewardship and generosity. And we're grateful for this work that we're about. In a lot of ways, our work is to support ministry across the state and to help churches and other related organizations do their work. We're going to be talking about tax advantage giving today, but that's coming with the assumption of kind of the theology of money and the purpose of the money. It's not so that we can just take advantage of the tax efficient options that we have. It's also so that we can make a difference in our world and that we can be good stewards based on the resources that we have been blessed with to change lives and to transform the community and the world around us. Tyler and I, when we present in churches and with families, we come with this theology of money. You may have your own theology of money. I'd invite you to consider what that might look like. But one component of it is this concept that God is the owner of all the stuff in our lives. We read that in Psalm 24, that God is the owner of the heavens and the earth and all that's within them. So it positions us not as the owner of stuff, even if we have a name on the deed or on account. We're part-time, caretakers of these resources. We are receivers, we are stewards of these resources, and we're responsible for how we use them to make a difference in the world around us. And our invitation for all of us is to think about how we can do that well and wisely, how we can be good caretakers of what we've been entrusted to make a difference in the world around us. You'll see at the bottom of this slide, John Wesley, in his sermon, The Use of Money, he uses the phrase that we're called to earn all we can, save all we can, and give all we can. And sometimes I find that if I think back in my past, I've done better at the first two than the last one. And I think we're called to continue to wrestle with what does it look like for us to do that? How is God calling us, you, I, to grow our giving to make a difference in the world around us? How do we live out the biblical values, be a biblical giver, and to be intentional with our resources and intentional with our giving, not just on a whim, but have that planned out, have been praying about that, be thinking about what that might look like, to be regular, to figure out how we give off the top and not what's left over, a first fruits kind of concept, give proportionally. And it seems that when we do those things and we're being joyful in our giving, we will be found faithful by those who come behind us. These kind of values are coming from this book, Ask, Thank, Tell, about how we are good stewards of our resources. I want to clarify that we're not CPAs and we're not attorneys. We're philanthropic advisors who work because of our faith and because of the charitable causes that we care about. And so I invite you to talk with your advisors and to think about what's the specifics for your situation, which we don't have that knowledge. So today our focus is on donor advised funds. And simply a donor advised fund is a charitable account, a charitable fund that is legally owned by a charitable organization like the Kansas Methodist Foundation. There are other providers who provide this kind of work and ministry. But it's a charitable fund owned by the organization. It's set up in relationship with you. You cause that to happen, but it becomes owned by the charitable organization where the donor has made contributions and retains advising privileges. to be able to give direction about how those dollars, in many cases, are invested, as well as how those dollars are given charitably to other 501c3 charitable causes, to the one who might be holding the funds for funds we might care for example, or for other charitable organizations. It's an account where you get a tax deduction in the year the contributions are made into the donor advised fund. You don't receive a charitable deduction when the money goes out, but only when the money comes into the account. And so one of the key components of this is the ability to clump giving into a single year. That's where we have the ability to make the tax advantaged kind of giving, is to clump multiple years worth of giving. I sometimes tell the story of a farmer that I was their pastor in one of the churches that I served. And this farmer would give their charitable gift to the church every other year. And it might have been coincide with good crop years, but that's not my memory. My memory was it was an intentional action to have a higher amount of giving in one year so that they could itemize and make a bigger difference with that gift. And so it was a matter of clumping those to get further above the standard deduction. And then lastly, the funds, once they're into the donor advised fund, they grow tax-free. And so the gift can come in, it can be given at one point in time or multiple points in time. We will invest it, it'll grow tax-free, and then it'll be used to make a difference in whatever charitable causes that the donor would so desire. So and we are a Methodist organization, and we want to support Methodist churches and causes and ministries, but we're not restricted in those types of 501c3 charitable causes. So we make distributions to other educational institutions, Boy Scouts, Boys and Girls Club, all sorts of 501c3 charitable causes that you care about. Are ones that we would be willing to help support. It really provides a way to bring together charitable giving, make the most advantage of that, and then to support all the things that you want to support. And so here's some, I guess, some reasons that you might consider a donor advised fund. Is it allows you to clump your giving, and we'll walk through some example case studies here in a moment, but it allows you to clump your giving to take advantage of the tax benefit in a single year. You still have the ability to advise. It simplifies the charitable giving to outside causes that you care about. You can provide provisions for future giving for yourself or for your family members. And as I said, it allows you to give in a tax-free kind of fashion. So back a few years ago, we changed, the government changed the level of the standard deduction and actually raised the standard deduction. And so this is the current standard deduction for us in our federal filing in the United States. If you're a single filer or married filing separately, your standard deduction is $14,600. If you're a married couple and you're filing jointly, it's $29,200. And if you're a head of household, it's $21,900. And so those numbers are a lot higher than they had been in 2017 and in previous years. And so a lot of times people's giving to their church or other things that would go on the Schedule A in our filing for the 1040, we would get to deduct those and get to, if you will, take a tax advantage in those costs or those gifts that we would make. But that changed when they raised the standard deduction. Maybe you see here in 2020, which is the most recent year that I have data, only 9% of tax filers had an itemized tax return. So 91% of the population in their filings use the standard deduction. And that's a significant change from 31% that was in place in 2017. And so it's really what we're talking about is, are there ways that you can combo your charitable giving to make a difference in the church or other worlds, and do so in a way that gives you some tax advantage for those gifts? There are other things that go on the Schedule A, but we're mainly focusing about the charitable giving and its relationship to the standard deduction. There are limits, and so that will be part of the equation as you think about your own situation. There are limits to the contributions that you or I can make into a donor-advised fund, a DAF, and be able to take tax advantage of it. You can do more than this, but you can only receive advantage in your 1-year tax return based on this. So the current rule is you can deduct up to 60% of your adjusted gross income, which is towards the bottom of page 1 on the 1040, in the year the charitable gifts are made. So 60% of adjusted gross income can be deducted from your taxes. In the event that you gave a lot more than that for some reason, you could carry it over to a future year, but you're only allowed to take advantage of up to 60%. Now, there's a caveat that they have in there. There's multiple caveats. These are the major ones, but you can deduct, your deduction is limited to 30% of the adjusted gross income if you're using appreciated assets. So if you are giving appreciated stock or land or rental property or some other kind of thing, you can only take advantage and have a deduction of 30% of adjusted gross income. So if you wanted to try, maximize your deduction, some of that other money is going to have to come from cash. So my wife and I set up a donor advised fund, and we put in some appreciated stock and we put in cash to be able to get us to that higher number. And the nice benefit of being able to give stock or land or some other kind of appreciated asset is that you get to avoid the capital gains. So you don't liquidate the asset, you gift the asset. So we have a process, especially with stock, that's probably the one we use more frequently, where people will give us, so many shares of Apple or whatever the stock is, and we will take receipt of those shares and then we will liquidate. So there's not a capital gains applied to that tax. The capital gains tax is applied as well. In the event that you are 70.5 years of age or older, and you have a traditional IRA, you have the option of giving out what's called a qualified charitable distribution. But one of the limits or one of the restrictions on contributions to a donor advised fund is it cannot come from your IRA account. At some point in time, each of us will have what's called a required minimum distribution. If you haven't gotten there yet, it's currently 73 years of age. It's scheduled to be 75 years of age when I get there. I'm 48, so I've got a little ways to go. But the RMD amounts have to come out, and you can do a qualified charitable distribution straight to a charitable cause, but you cannot do it into a donor advised fund. The IRS doesn't want us to double up, if you will. Yes.
Before you move from that, I was going to make a comment on when you give an appreciated asset, you avoid obviously paying the capital gains on selling that. But if your plan is to leave that asset in your donor advised fund for any period of time, you also avoid having to pay taxes on the earnings that occur. So if you gave the Apple stock in the example, and you don't plan to maybe distribute some or all of it for the next few years, any dividends and gains that take place just continue to earn inside that tax-free environment, and you have more money when you actually send it out to your charity.
Exactly. It can grow tax-free, and you don't have to pay on the dividends or interest or the appreciation further from that moment on. That's exactly right. And so some of the families will give a gift into the donor advised fund and have the expectation, I'm going to distribute this in the future, and I want it to grow even further from where it's at now. It doesn't have to go into, if you will, a cash account kind of scenario. It can still be invested in the market and still be making gains over a period of time, and all of that will be tax-free. Exactly.
So basically, the person is avoiding having to pay the income tax on the dividends and capital gains that this asset would have been generating because they owned it personally, not
Exactly.
inside an IRA.
Exactly.
So that's
Exactly.
a double plus.
It's a double plus. Exactly. Thank you, Sandra. Some of the limits, those were limits on the contributions. On the limits on distribution side, so when money goes out, it would have to go to a 501c3 charitable cause, a qualifying organization. It cannot go to like a person or to some other kind of non-qualified entity. And then another consideration is, are there any, it's really about the partner that you use to care for the donor advised fund. We've heard of some scenarios where there's a donor advised fund at an organization where they have restricted what kind of distributions, what kind of things the distributions can go to. But you might just be cautious of that, or look into that, of what kind of things would your partner who would own the donor advised fund be willing to make distributions to support. So I want to walk through 4 kind of case studies, and these are all hypothetical ones. I've named each of the persons, the families, to kind of be playful on the name of what's happening. And again, it's me trying to help you think of possible ideas and considerations for your own situation, not knowing what your situation is. So the Clark family, the Clarks, the clumping couple, is this family, the #1 case study. The Clark family is considering a donor advised fund at the Kansas Methodist Foundation, and they've looked at their tax return the last couple of years, and they have awareness of their current receipts and income for this year, and they're making a best guess that their adjusted gross income is going to be $150,000 in the current tax year of 2024. They're a married couple. They're filing their taxes jointly, and so their standard deduction is $29,200. And they have been a family that's been charitably inclined. They've been giving roughly out of their 10% of their adjusted gross income to support their church, plus 2% to support other charitable causes, other 501c3 charitable causes that they care about. And so their total giving has usually been about $18,000 per year. So that's their scenario. And because the standard deduction is so high, they have no longer been able to itemize on their return, because they still need more dollars than that Schedule A to be able to itemize. And they have been investing regularly in a brokerage account, and so decided 2024 is their year, and they decide what they're going to do is clump their giving for multiple years and try to maximize their contribution and their tax advantage. And so they're going to give just under $90,000 into the donor advised fund in this single year. I have a online kind of tax prep document that I've looked at, and I just focused on the details of what's the savings to their tax if they just do this action, no other considerations. Their estimated federal tax would be just over $6,700 for this year, instead of $16,600 if they were not trying to do this tax advantage kind of giving. So almost saving $10,000 in tax by clumping these gifts. So how are they going to do it? They've calculated 60% of their adjusted gross income is 90 grand. And so they have the option to give up to 30% of adjusted gross income of appreciated stock, which would equate to the fair market value of $45,000 for that stock, as well as cash gifts of $45,000. So that's the amount of money that they can give out totally as their family and be able to do an itemized tax return and take advantage of that. And so this family actually decides they're going to give their normal gifts, their normal process of giving, which is coming out of their bank account, cash gifts to their church and other charitable causes like they normally do for the $18,000. And then, so that's down here in this graphic. And then in addition to that, they're going to give $72,000 into a donor advised fund. And they're going to fulfill that with appreciated stock, so they don't pay the capital gains of $45,000, and then an additional $27,000 of cash. Now, if they don't have that cash on hand, or one of their accounts doesn't have that much cash, they would have to sell something or liquidate something to have the cash to be able to do that. But their intent is to give 90 grand total charitably to the donor advised fund or to the other causes in 1 year. And get as close to that 60% of adjusted gross income as possible. And what the intent is that the donor advised fund at the foundation then, in future years, will give on behalf of them, and I've got the number increasing here because we're going to invest it, and maybe to keep up with inflation so they still make a similar kind of impact in those organizations. They're going to distribute that money until it runs out. We don't really necessarily know exactly when it'll run out, but their intent is to give it and distribute it until it runs out or closer to zero, at which time they would repeat this same process in like 2029 and fill it up with new gifts to be able to make a difference in their charitable cause and to take this almost $10,000 tax benefit. The way that we maximize the tax efficiency is to get as close as we can to the 60% limit, 60% of adjusted gross income. And you have to calculate that for you, whatever that might be. If you set up a donor advised fund and you put in $5,000, that's an option, but it doesn't get you high enough to then itemize. And if you gave enough just to get just above the standard deduction, then you would be able to itemize, but your ability to be tax efficient is not leveraged. If you think of a lever, the farther you are away from this line and closer to this line, the more advantage you can take in this charitable gift and this clumping activity in this 1 year. And so, thinking about what does that look like and how do we move our way up there to make the biggest difference. Now, consider also there's other pieces that are going to be in your Schedule A that are separate from the charitable part that would make a difference on your tax liability in that one particular year. And so maybe that is you take a full year's worth of property tax and you pay it in 1 year. Instead of kind of spreading it out over a couple different payments. That might be another consideration. But trying to figure out how you make it most tax efficient, and there are some pieces to this that make it challenging for some scenarios and some family situations. I mean, you have to have enough of the resources that are in a taxable account to be able to do this, in some brokerage account or liquid cash, to kind of get this ball rolling in this process. So that's one piece. Another challenge is, once you get it rolling, is to continue to put money into investments so that when it gets to 2029, in the Clark's example, you can do it again. So what my family does is, the money that we would have been giving to our church and other charitable causes, we're investing those dollars so that when the donor advised fund runs low or out, we have the money ready to do this again. And so it's a thinking about building this process that makes a difference. So that's the Clarks. the clumping couple scenario. The next example that I want to walk through is the Wilson family. The Wilson family receives a windfall. Um, the Wilson family is considering a donor advised fund at the foundation, and they receive a taxable windfall from a business venture that sold here in this year, in 2024. It already sold. It's been fully transacted. They've gotten a large pool of resources as part of it, and will have to account for that on their taxes. My illustration here is they have a $1.1 million taxable income from this windfall, plus their normal annual income for their family's household of $100,000. So that's the scenario, the case that I'm painting here. They are like the Clarks, they're regular and generous in their giving, and they decide they want to use a donor advised fund, and they're doing it this year specifically because of this large windfall, so that they can reduce some of their taxes, and so that they can have a pool of money that can fulfill their charitable giving for the coming few years. And so the Wilsons decide they're going to only do 40% of their adjusted gross income, not the max, because they need some of that other money that comes from this sale of this business to support their living. And so they're trying to find a balance of creating a donor advised fund for charitable giving for multiple years, as well as to support their living now that this business has been sold. And so they're putting in $40,000, which is roughly $480,000. There's the same issue of, how does it come in? 60% from any source, about 30% from appreciated assets. So depending on how their windfall comes might play out. And I used that same program online, and I ran the estimated federal tax, and their tax savings is $166,000 of tax savings. We just take this piece as part of the equation, their federal return, by doing this. And so I think when there are families that have big contributions, this is a great consideration. Maybe there's a non-taxable windfall that a family might receive. If an inheritance comes in, it's a large distribution from some trust, that might be a great opportunity and situation to consider doing this. It's so that we have the money in a place that can help us give charitably. If a family is not charitably inclined in any way, then this wouldn't be a good consideration. But if they are, it's how can we make the most of that, and especially how can we take advantage of a taxable windfall with the Wilsons. The third case is one of the Lewis family, and the Lewis family is loading up late. So they're a little bit later in their working career, and they're charitably inclined, and they're at a place in their lives where the receipts that they're receiving for their working employment is higher. Their compensation is at a higher level than it had been at previous times, and they're charitably inclined, and so they want to take advantage of this time. They don't need all that income in the same way that they needed it at other stages in life. And so because they're charitably inclined and have an intention of retiring in a few years, they want to have a donor advised fund that will help fulfill their charitable giving, and be able to extend that until they get to 70 and a half and can use their IRA to facilitate their charitable giving largely in that phase of life. And so for this year and for the next 4 years, the Lewis family is intending to give it more aggressively into the donor advised fund, with the expectation is they're trying to build the account so that it can be a charitable tool for them in the coming years. And so this family decides they're going to give 40% of their adjusted gross income into the donor advised fund, which equates to $80,000. And it's going to reduce their tax burden their intent is not what was happening in the first illustration of load it up and then spend it down, load it up. It's more like load for a few years and then make bigger distributions when the income has reduced in their early retirement years. And so I think there are lots of scenarios where this can be a great tool for families to make a difference in the causes that they care about, as well as to provide for the wishes that they want to do for their whole overall money management and their charitable giving. The last illustration I want to give is the Eddy family. And the Eddy family is wanting to give from their estate. So that is their charitable intent. And this is kind of amplified because of the secure requirements from the Secure Act, the requirements of from a IRA account or a 401k or 403b, a qualified retirement plan account, that the receipts of those dollars, if it's a person as the beneficiary, they're going to have to take those dollars over the course of 10 years. And so thinking about how to use, for instance, our IRA accounts to help facilitate giving to a donor advised fund is a great consideration, or we might think of it within our whole plan for a trust. So here in the example, the Eddy family, they have an estate plan and they have a trust, and they're intending to give to each of their children 1/4. So in essence, they're adding their charitable giving as one of their children. And so they're going to give 1/4 to each of their 3 children and 1/4 into a donor advised fund, for example. And so their trust documents are set up such that makes the most tax advantaged distributions from their trust, which is going to be any monies that are in these qualified plan assets, first and foremost, into the donor advised fund. Now, I said earlier that you cannot give a qualified charitable distribution out of an IRA to a donor advised fund. That's the case. However, upon a beneficiary at the end of a person's life, there is the provision where we can do that to a charitable cause. So the Eddy Family Trust, upon death, is going to distribute 25%, and I'm using a net estate of $500,000, and so they're going to give 25% of the net estate, which in this case is $125,000, to the Kansas Methodist Foundation, and the dollars to go into the donor advised fund. Maybe they already had a donor advised fund, and mom and dad were using that. But the plan is that their 3 children are going to be the advisors of the fund after mom and dad have died. And this new contribution gives them the ability to give direction. And so they gather these 3 children, they gather once a year, and they decide what kind of distributions they're going to make out of the fund. They know they can distribute all $125,000 each year. That's how the donor advised funds are set up. You have the agency to advise to distribute all the dollars, but the kids decide they're going to distribute it over a period of time, not all in one big clump, but over the course of a few years, in this example, 10 years. So they get together each year and give advisements about where this money will go in memory and in honor of their parents, and in some ways priming their charitable giving to make a difference in their own lives and in their own stewardship. Using a donor advised fund is an option for, fulfilling estate gifts. More of the families that we work use a permanent endowment fund or a term fund for a set number of years. And put in place a memorandum of understanding with us to steward that charitable wish. So more families do that, but it is an option to create and use a donor advised fund for that purpose. It gives you more options and possibilities for the distributions. The main issue is just who's going to become the new successor advisor on the account. We've even seen where there are families that have considered a family foundation as a way to carry on the family name and to be able to be a steward of charitable dollars to support their community or their church or other kind of causes that they care about. And that can work. And a donor advised fund actually is a great alternative to a family foundation. The donor advised fund is easier to set up. There's not the same kind of tax filings that have to be done that are required with a donor with a family foundation. There's not the excise tax. And one other nice thing is that you can deduct a larger part of contributions that go into a donor advised fund. And so some families that might traditionally have thought of a family foundation could set up a donor advised fund, and it would accomplish the same kind of charitable wishes, but be simpler and easier to administer and still make the same kind of impact. So I think there are different ways that we can make a difference with our donor advised funds and our charitable dollars. These are 4 of those kind of examples. Are there questions that people have before I move on?
I don't see any. I don't see any in the chat. By all means, you can raise your hand or put a question in there. You were talking a little bit about the advantages of the donor advised fund over the family foundation. You're also not required to spend a certain amount out of the DAF, right? The
Right.
family foundations have to give 5% annually. In a DAF, you can spend 5%, 10%, no percent, depending on what that year's kind of returns and desires are.
Yeah.
Very more flexible than the family foundation.
Yes, that's another advantage that you would have with the donor advised fund. I've heard of some organizations that require distributions over a period of time. We don't have that at the Kansas Methodist Foundation, and so we want you to use the donor advised fund to fulfill your charitable wishes, whatever that might be. When a gift comes to us in stock form or in cash gifts, charitable gift receipt will be issued to you, and then you can use that as part of your annual tax filing. If it is a stock gift or some other appreciated asset gift, there'll be one based on the fair market value for the day that the stock or whatever is given. A couple pieces of kind of how we structure them. We have a minimum size of $1,000, which is pretty low. If you set it up there, you may not have a lot of tax advantage by having one of that size, but that's something that could be possible. We do have minimums on the monies going out, and more of our families that use the donor advised funds don't. More of them do a little bit larger gifts less frequently, but the minimum distribution is $100. It's really about the administrative process for us to be able to make that distribution. Once the account is funded, then the fund advisor, the donor who has made this happen, and can give advisement on how to distribute the funds to support the charitable causes. And some of their families we will just wait until they give us directions and give advisement on it. They're kind of more one-off kind of times when something comes up. We have other families who set up a schedule of planned distributions. So they say, for 2024, these are the distributions we want to make, and this is kind of the timeline we'd like to have. Some of them, it is, wait until we talk to you. So we keep them invested in alignment with the expected time horizon, and then wait until they give us direction about how they want to do it. Our new sub-accounting system allows us to have an online fund advisor portal. So if you have an account with us, my wife and I do, we have a donor advised fund at the Kansas Methodist Foundation. We can go online. This is a screenshot from our online process where we can open up our account. We can set up a grant request to go to my church or the foundation's Cornerstone Fund or whatever it might be, any 501c3 charitable cause, and can enact that. And so this new process has made it even simpler than what we've been able to do before by making these requests possible on an online platform. And so I think there's some great advantages by doing a donor advised fund and doing a donor advised fund with us. There are other options, but we are a good option that you might consider. The money is professionally managed. We're holding to your donor intent and keep track of that. We seek to be in relationship with you and to help you in your stewardship and your generosity. We invest the dollars with Westpath Institutional Investments, which is the entity that cares for all the pension of the United Methodist pastors and many other Methodist-related institutional dollars. And the money's invested in alignment with the values of the church. And so they do good with the money and they make good returns. And I think it's something I feel comfortable and confident about, the money that I have placed into the fund. Like I said, we're seeking to help you more holistically. If you do decide to put in place a permanent fund or a term fund to support your church or other causes, we can make that transition happen easily. That's how mine is set up. At the end of my and my spouse's life, the donor advised fund will go into our permanent endowment to support the things that we care about. The administrative fee, which would be 0.75% on an annualized basis, supports our unique faith-based ministry of stewardship and generosity with the church, partnering with people to grow those resources, to do ministry that God is calling us to be about and to make a difference in our world. So if you decide you want to put in place a donor advised fund, we want to talk with you and kind of help figure out how to do that well. But the bulk of what we need is kind of contact information, your names, who you are, an intention about what your timeline is. So if you are putting in place a fund, but you're not planning to distribute it for 10 years, then we want to invest it in a different way than what would happen if you put money in today and are going to distribute over the next year or two. And so, having a sense of where the money's coming from and what the investment strategy is. The last piece is really what happens if you no longer are able to give us advisement. So if you are the donor that is advising and you no longer can, what do you want us to do with the remainder? Maybe it's put it into a permanent fund, or maybe to name children or others to be successor advisors, or maybe it is to distribute the funds out fully based on some schedule or some plan that we would put in place together so that we can administer those in a way that make a difference in the things that you care about. So a couple of things I want to highlight here, and then we'll go to question and answer. I talked a bit about the giving from an IRA and qualified charitable distributions. I want to point out that we did a training similar to this on QCDs and IRAs back in January, and the content is recorded, and it's kind of a deep dive about how we deal with our IRAs and give those to support charitable gifts. The address is on here. It's also on our website that you can go and review. I want to make an advertisement. We're going to do another of these webinars related to memorial planning and how you can give a gift to your loved ones that Tyler's going to facilitate in just over a month. And so just thinking about one of the best gifts that we can give to our loved ones is the gift of confidence, the confidence of knowing that your loved ones can honor you. They know, what your wishes are. You're able to put together a kind of a packet of information so that they can celebrate you. Sometimes we have scenarios where there's a lot of anxiety and there's a lot of technical things we have to figure out, and we have to go chasing things down, and it's often a big blessing and a big gift when those things can be given to us ahead of time. And so we'd love to have you come on November 12th at 10 a.m. for that webinar. And the last one is I want to just highlight a new ministry that we've been doing almost for 2 years now. I think we've had about 155 families go through this, and it's called Putting Your House in Order. And it's a kind of holistic estate planning process. It's the intent of it is to learn some information, but it's also to take action. It's to get some tools in place. So the first, it's actually over the course of 3 different months. We do a training session, and you learn some information, and then you are given a tool to help kind of make progress on putting in place a will or a trust or your durable power of attorneys or your living will, your advanced directive. And we don't draft the documents. Rather, we help you kind of with this planning worksheet, and then we help you get to an attorney. If you have your attorney, then we want you to do that with them. If you don't have one, we'll help you find one with attorney network that we've kind of worked on. So that's one step. Another one is a legacy giving. So if you want to do something charitably, what's the best instruments to do that from, and how do you put that in place, and what would that look like for you to give? And then the last one is related to this last webinar I just spoke about, of being able to give a gift to our families, to have a memorial planning, to have awareness of where's all my passwords and what are the stories, and who are the people that are most important to me, and how can I remember that as a part of my life. It's kind of this holistic putting your house in order that we want to help families update their plans or put their plans in place and to get that accomplished. And so there's a QR code here where you can go on and sign up if you're interested. We'll have kind of a new launch of this that will happen in the new year, so that families can put that in place. And if you decide you want to use us to be the steward of the charitable part, we'd be happy to seed that fund with a contribution from us. So would love to have you or others that you know about go through the Putting Your House in Order program. I know some who are on this call have gone through that. I think it's an important piece for making a difference in our world. So I want to figure out if there are any questions you might have about a donor advised fund, or thoughts you might have about how donor advised funds can be a great tool to be a part of your holistic charitable giving. We'd love to hear from you.
Anybody have a question as we're closing out the day and everything?
Well, this is Val, and I don't necessarily have a question, but I'd like to make a comment that I'd been introduced to Reverend Petz, and we had him into our church, and he encouraged the putting your house in order. So I went through that series with Tyler this year, and it was mind-opening on the different uses of our money for charitable purposes. And Monty and I had our estate set up for a number of years. And just the way the presentation was made was something that had more a spiritual aspect to it. And certainly our denominational aspect applied. And so we were able to go back to the attorney and make differences in our end of life documents that take more into effect the United Methodist Church and how we're going to help continue to build the world as the Wesleys saw it. So I appreciated the opportunities to be involved with that and to get to know Tyler and Reverend Petz more deeply. So thank you very much.
Thank you, Val.
Thank you, Val.
I think there are some great tools that are out there, and figuring out what that looks like for each family is unique and different. We have a few families who don't use the donor advised fund, but they give their charitable gift every year from appreciated stock, and so they'll give to us their shares of stock, we'll liquidate them and fully distribute the dollars to the church. And it can fulfill their charitable giving with appreciated assets. And so I actually had one family that had been doing that for a while. And I contacted them and said, if you have the resources, so I mean, a donor advised fund works best if you've got enough kind of momentum and some resources to begin the process. But they're in the process of considering, do I do what I've been doing, which is using some appreciated stock, but then just add the component of clumping a few years worth of giving and be able to set up a donor advised fund and begin this kind of process. So I think there are ways that we can be great stewards of the resources in our lives and do that during life and in our estate planning. And if there are ways that Tyler or I could be a part of serving you or people that that's our wish. That we're here to help you make the most of your resources to make a difference in the church and other causes. So
Final thoughts, Justin, before.
I don't think so. Thank you all so much for being here. I'm grateful for you, and there's ways that we could serve you. Please let us know, and let me offer a prayer as we end. Gracious God, we give you thanks. We ask that you might continue to lead us into our day, that you might help us prepare for the rest of this year and dream and think about how can we use what we have been entrusted and what we steward to make the most difference with it. And maybe it's planning for what that might look like for now or in later seasons of our lives. God, we know that you are at work in us and through the organizations we care about. We pray for your Spirit to bless us and to lead us. Help us to look forward to that day when you welcome us home and you say to us, well done, good and faithful servant, enter into the joy of your master. God, we give you thanks for one another in this time. Bless us in this day. It's in Jesus' name. Amen.
Well, thank you, Dustin. Thanks for everybody for being part of today's webinar. Hope you've learned something. We will send the slide deck out, so be looking for that. If you do happen to have any questions or comments, feel free to reach out that way. And we look forward to seeing you at future programs and presentations. If we can ever be of service to you, your church, or your Sunday school, those kind of things, we're happy to join you in person or perhaps on a Zoom kind of link as well, where we can provide some of this training to other people who are part of your circle of influence. So thanks so much for joining us today, and we'll see you all next time. Have a great rest of the day.
Thank you. Bye-bye.